Good evening. We'll call this special meeting of the Board of Finance to order. Please join me in the Pledge of Allegiance.
This last night, I haven't changed my patriotism.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. So welcome. We have guests with us tonight. I'll have you introduce yourself so I don't get your names wrong. But thank you for coming here to go over the comprehensive annual financial report, which is the audit of the town's businesses. But for members of the public, we do post it online on the finance page. And I know this is going to sound weird, but it's actually very interesting to read. There are lots of statistics. If you don't like to read this sort of stuff, go to the back, and there's all sorts of fun statistics about the town. You can really learn a lot. And I want to thank you for putting it together, and I want to congratulate Amy for putting together an outstanding document. A lot of work, and Kelsey, I'm sure, helped with this, and Maria, and probably Melissa, and probably others, everybody, but it's a monumental piece of work. We've been recognized multiple years, over 2 decades now, for excellence in financial reporting, and that's because of the staff who puts in the hours and the work, and I just want to recognize them tonight with our thanks. And with that, I will turn it over to you. We do have a budget meeting afterwards. I think we've all had a chance to review your slides, so probably with a pace. Thank you.
Good evening. I'm Nicole. I'm a site principal with CLA. And with me today is
Jessie Anisco.
She's a manager. I'm a principal. We are both tasked with the audit of the town of Simsbury. We have put a presentation together with a summary of the audit results. So you can see on the second page there's agenda. We'll go over terms of engagement, executive summary, financial highlights, and Jess will go over federal audit, governance communication, and management advisory later. And then I'll close it with a very short summary of upcoming GASB pronouncements. So on page 3, just as we've mentioned in the past, those are the terms of engagement. We were engaged to express an opinion on whether the basic financial statements are free of material misstatements, and express an opinion in relation to opinion on the schedule of federal awards and schedule of expenditure for state financial assistance, and express an opinion on compliance related to the major federal and state programs. In addition to that, we are engaged to report on internal controls over financial reporting and compliance with laws and regulations. And in addition, there are a couple of other reports on internal controls over compliance with the state and federal major programs. On slide 4, there is an executive summary of the audit results related to the financial statements. We express an unmodified opinion on the financial statements, which is the highest level of opinion that an entity could get. Included in the opinion report is an emphasis of matter paragraph to alert the reader of the implementation of GASB 84 fiduciary activities for the current year, and a restatement that was needed on the net position of governmental activities and fund balance of governmental funds related to reclassification of agency funds to special revenue funds in the current year. And
before you go on, can you just repeat that thing you said with the second square, unmodified opinion underneath that?
The unmodified opinion?
Yeah, can you just say what the sentence?
That is great, is the best thing that could happen, the highest level of opinion that any entity could get. So.
I thought that was worth repeating. Thank you.
And again, the emphasis of matter is just to alert the reader that all the new accounting pronouncements that were implemented in the current year. There was a restatement of $648,000 to show an increase in net position and governmental activities fund balance for the fund agency funds that are now reported as special revenue funds. And another highlight is there were no findings reported on internal controls over financial reporting. So that's another clean report and achievement. In the next couple of pages, I have some schedules that came from the financial statements, very high-level summary, just so anyone can see how the town did at year end. On slide 5, there is a summary of governmental activities, which are all the funds of the town, general funds, special revenue funds, capital projects, with exception of the OPEB and pension trust funds. So as you can see on this page, the town ended with a net position of $122.5 million versus $117 million in the prior year. And as you can see here, total assets increased from 198 to 211, and liabilities increased slightly. But overall, the operations are net position increased year over year, so I guess I have nobody to hear me.
Well, can you just define what non-current liabilities are, please?
So non-current liabilities are bonds payable, net pension liability, net OPEB liability, compensated absences. So all those liabilities that you normally don't see in the fund financial statement, so they're not in the general fund. The only place where you see this non-current, those liabilities are in the government-wide financial statements and the governmental
Just confusing,
activities.
because we are currently liable for those things, right?
But they are long-term liabilities.
They're the long, they're
we're
the total.
still a liability.
Well, it's the total, it's the debt, pension, and OPEB unfunded liabilities that we owe, right?
Yes, so
Okay.
that's the majority
Big
of those
three, right.
liabilities. So those total liabilities went actually kind of stable year over year, and a big reason for that was that the net OPEB and net pension liabilities at year end decreased in comparison to prior year because of the good market conditions at the given date, because the reports are at the given date is June 30th, 2021. How it is now, it's a different story, but that's how it was on June 30th, 2021. On page 6, there are some financial highlights related to the governmental funds. As you can see here, there are 6 columns. 5 of them, the first 4 columns are what we call major funds, and any other funds that are not numerically or quantitatively high enough, they go under the same column, non-major governmental funds. So for all the funds of the town, the fund balance at year end is $45 million, and that is an increase of $12.6 million over the prior year. And as you can see, total fund balance and total net position are 2 different things, because in the net position you have long-term assets such as roads and bridges and buildings and land and everything else the town owns is as an asset, so that will increase your net position. But all those long-term liabilities or assets are not included here, so there is a difference between what you see in the government-wide and fund financial statements. General fund ended the year with about $18 million of fund balance. Sewer use fund, $7.3 million. Board of Ed programs fund, $805,000. Capital projects, $12.4, and all the other funds combined are $6.5 million.
And, sorry to interrupt again, can you just define what a non-spendable fund balance is?
So the fund balance that it's non-spendable is in nature of the fund. So, for example, if you have prepaid liabilities, you already spend them. Prepaid assets, I'm sorry, they already spend them. They are as an asset. The other side is an equity or fund balance, but it's not spendable because you cannot spend it for the future. Or inventories, you already spend them. So the other side will be an unspendable fund balance because the money already went out the door. So those are the type of items that go under that category.
No, that's the capital project fund is where we fund projects that have been approved, so that where we've either raised bond money, capital cash, capital, it holds
That's not just
it's the checking fund, not the savings fund for approved projects.
Slide 7, I summarized their general fund. As I mentioned, the fund balance at year end was $18 million. Non-spendable is $159,000. Committed for education, $651,000. Assigned for encumbrances, $215,000. And what's left over basically out of the $18 million, $17.8 million unassigned fund balance. And you can see on the next page, the general fund balance is a percentage of the unassigned fund balance as a percentage of the expenditures and transfers out over the years. So you can see there was a slight increase from 2017 to 2021 and been kind of stable for the last 3 fiscal years.
We had planned for a 15.5, and we came awfully close to that.
That's very good, yes. Yeah, so that was 15.43 or something like that.
Right.
On slide 9, again, there are some financial highlights related to general fund budgetary results. So on budgetary basis, general fund revenues were $1 million higher than budget. Included in those revenues were property tax collections that were $595,000 above budget. Collection rate was 99.6%, and that's slightly higher than prior year collection of 99.4%.
I had a question on that. If our tax collection assumption rate is 98.5 and we collected 99.6, you would think it would be $1 million, but in talking with Amy, and Amy can use the terms that I'm going to forget, that gets discounted by prior years and other factors, so we usually end up, even though we have a conservative tax collection rate, not that big excess. It's usually $500,000 to $600,000. And can you articulate why that is?
That's just prior year refunds.
And this collection is on everything related to tax collection, not just the current year levy. It's prior year collection. As we all know, those collections are not. As the years go by, those collection rate for those years goes down, and they. But including here, then again, are any lien,
Right.
The liens that are collected, any other fees and interest. So you wanted me to quantify the number? Okay.
No, that's perfect. I just want, we get asked that question a lot, and it sounds like it's going to be $1 million extra, but it's usually between 5 and 6 for those reasons.
Yes.
Okay.
As far as the expenditures go, general fund expenditures were $1.8 million higher than the budget, and there was a transfer to capital project fund for about that amount. All the other categories were within the budget. Only the transfers out to the capital fund were $1.8 million higher than budget, and I'm pretty sure they were all approved. Included in the financial statements are there's a section for proprietary funds. The town reports health insurance fund in that section of the report. Net position of the health insurance fund was $5.1 million, and that represented an increase of $740,000 from prior year.
So what you're saying there is that as of the date you audited, which was July something,
It's June 30th, 2021.
so at the end of 2021, we had $5 million.
Correct.
In there.
Fund balance.
And so do we just put 1/12 of our expected
Claims.
budget in each month?
Pretty much.
And so 1/12 is about $5 million?
No, the reserve would be anything that's excess revenues in excess of expenditures.
Because
So,
we had that 40% extra in there,
so
yeah.
all of our claims that came in better than expected, that's the majority of the fund balance.
Okay, so this is 1 month plus IBNR. So what's 1 month roughly equal? Off the top of your head? Okay. Okay, thanks.
IBNR was about $957,000.
So 1 month would be about 4 million? Okay.
And the revenue for the year was $16 million, and The claims plus administration fee for the year was $15.8 million. So the claims were below what the contributions to the fund were. So that's why there's an increase of $740,000.
So you said contributions were about 60 million?
16,
16.
1/6,
Oh, that's the employee contribution.
and town.
That's both.
But you said claims were 50
The
million.
claims were $15.8 million.
15.
1.5.
15, 1.5, I'm sorry.
I mean, we had a lot of discussion about this last night.
In the next couple of slides, there is some information about pension and OPEB changes in net position and the funding level as of June 30th, 2021. On page 10 there, net position of all trust funds, which are the three pension trust funds and the OPEB trust fund, ended the year with a net position of $100.6 million, and that was an increase of about $20.6 million if you look at all the way on the right, the total column. So as you can see, the main reason for that increase was that the total investment income in the current year was $21.3 million. And as I mentioned a few minutes ago, was that the results as of June 30th, 2021 were very positive, and that that caused for that the majority of increase in the net position. On page 11, you would see the net pension liability for all three pension plans and their level of funding. So general government plan had a net pension liability of $8.5 million, and the plan itself was 78% funded. Police liability is $2.9 million and has had a 91% funded, and Board of Education had a liability of $7.1 million, and the plan is 81% funded. OPEB liability for the retiree health plan was $4.9 million, and the plan is almost 82% funded. So this concludes the summary related to the financial statements, and Jess will go over federal and state single audit, but I need to move this for a second.
All right, as Nicoletta said, in addition to the financial statement audit, we are also responsible for a federal single audit and a state single audit, and what that is looking at the grants that the town receives. We had unmodified opinions on the major programs that were tested for both the federal and the state, and we had no internal control findings, as Nicoletta had mentioned earlier. The total federal awards this year was $3.1 million. The prior year was 1.8. The big increase this year was mainly actually because of the coronavirus relief grant and the ESSER K-12 grant, which are actually the two grants that we tested this year. So over those two tested programs, we had no compliance findings. On the state side, again, we had no findings on the programs and no internal control findings. The total state awards expended this year were 12.6, but only 3.2 million is subject to our analysis on what grants we're going to test. So this year we tested the Open Choice Grant, the Town Aid Road Grant, and the Small Town Economic Assistance Program, also known as the STEEP Grant. Questions? Yeah. So we have a small typo on this slide. The new standards adopted this year, GASB 84, which Nicoletta went over, was adopted this year, which caused that restatement that she spoke about. Also included in any financial statements are management estimates. So we review these estimates to make sure they're reasonable, make sure there's no management bias in them. As far as the net pension liability and the net OPEB liability, the town uses actuaries that come up with those liabilities, and we incorporate their reports into the footnotes. The depreciation expense is based on the useful lives of the capital assets, which again is determined by management, so we'll just analyze those and make sure they're reasonable. The allowance for uncollectible receivables, that's the piece of the property taxes that, for one reason or another, I know Amy meets with the tax collector and they kind of go through the list to determine what may not be collected, so that's where that allowance is coming from. And then the IBNR healthcare costs, the town uses a third party to estimate what's going to be coming in the next couple months after year end that relate to claims prior to June 30th.
Just for members of the public who might be watching, IBNR is issued but not reported?
Incurred but not reported.
Incurred.
Incurred but not reported, yep. We're also required to have some various communication after the audit. That's why we're presenting the audit and we're here before you tonight. We had no disagreements with management. Management didn't consult with any other accountants, and for that, if management came to us on how to handle a transaction, they didn't go basically shop around if they didn't like our answer. We had none of that. There were no difficulties encountered in performing the audit. We did have an immaterial uncorrected misstatement. This is in relation to the amortization of the bond premiums on the debt. So in the past, the amortization method that was used was straight line. It was changed to the effective interest method this year. So in that change, expenses were overstated by $433,000. That's not a material amount, which is why we did not make the entry, or Amy did not make the entry into the financial statements, but we are required to let you know that that wasn't made.
Can you explain to us what is the effective interest method and how that differs from the previous method?
Sure. So in a straight line calculation, you basically take the premium, and if you had a 20-year bond, you're going to take a piece of it each year over 20 years, the same amount.
Right.
The effective interest method, you recognize a portion of the premium based on the interest that was expended each year. So as your debt goes down, your interest goes down, so you're actually recognizing more premium upfront in line with the interest expense, because you will be paying more interest upfront in theory when you owe more. So as it goes down, the premium would go down in a similar manner versus just a straight line method.
Oh, and so that Amy, is the theory behind that to create capacity in the debt service, or?
Not my call, that was their call, the change in standard.
Is that just industry standard recommendation? What's the theory behind the change?
To answer your first question, that is done only on the government-wide financial statements, the Exhibit 1 that I started with, and it's part of the included in that non-current liability. So the idea behind it is that you kind of match how much of the premium you are recognizing, because the premium is a revenue, versus the expense that you are recognizing for the interest expense if paid on the bonds. So if those numbers are small, most of the time they are not material, so it doesn't matter which method you use. You're kind of closely going to amortize year over year the same amount. But if the interest, you have a lot of bonds going on out there, and the interest goes significantly down year over year, in the beginning of the years that interest is very high, you really want to match the revenue with the expense. Like Amy said, it was not her. We had allowed for that to happen over the years, but the precise method to do it is the interest method. So you basically get the percentage of interest, what you pay every year, and then you apply that to the premium, just so you can match better the revenues and expenditures. So when you...
So just in accounting, does it change our debt service?
Does not change your
Okay.
debt service at all. It's just for the first financial statement presentation.
Perfect, that's perfect.
Could I
Thank
just
you.
ask two questions that I think are implied by the fact that we have an unmodified opinion? One is, did you receive all the information you needed to make your assessment?
Yes.
Were you denied access to any information? Okay, thank you.
Thank you. So for members of the public, that's one of our fiduciary obligations to ask questions like that, and we knew the answer to that in advance, but.
We thought we did.
We were also independent, and all the members of our team were independent from the town, so. The other thing wanted to discuss is just the management advisory letter. These are not findings, they're recommendations for improvement. We had no additions to the letter this year. All the items that are on here have been on here for a couple years, and we're close to being taken off of here, except then COVID hit and your implementation of your system was delayed slightly. So the capital asset reporting, Excel spreadsheets were still used this year. The plan is, once the system's fully up and running, to get those into the system. The fraud risk assessment, again, was postponed slightly because of the pandemic, and I think the plan is for fiscal '24. It's year 3 of your 6-year capital plan, so that's coming up. And then the accounting procedures manual, again, with the implementation of the new system, once everything is up and going, then those procedures can be documented. So there's no new comments. These are ones that have been carried forward and are kind of in process with the new system implementation. Turn it back over to Nicoletta for GASB.
So the last 2 slides have a listing of what is going to be implemented in the next 2 fiscal years. As you can see, GASB likes to keep everybody busy. The biggest one of the statements that needs to be implemented for next year is Statement 87, leases. And depending on the amount and the number of lease agreements that exist in the town, it can be a very costly statement to be implemented. A lot of time is needed to go through those lease agreements and to determine their application related to GASB 87. So basically, in broader term, what that statement will do is that any leases that in the past could have been considered either capital leases or operating leases, now they're just leases, and if they are over 12-year period, 12-month period, so over 1 year, they are going to be reported as liabilities in the financial statements, but not in your fund financial statement, in the government-wide financial statements, so in the first and second exhibit of the financial statements that you see. So that will be the biggest change, but to arrive, and most of the financial statements are going to change to reflect the GASB 87 implementation, but to arrive to that, it could be a lot of work depending on number of leases that the town, Board of Education, and any department of the town has, because they were all together going to be included in the same statement. So we've been talking to management about this statement for the last couple of years. Mamie and the group are all aware about the statement, and I'm pretty sure they've been working about creating inventory and see how all these agreements apply. And for next year, 2023, there's another 3 standards that are listed in there. I highlighted statement number 96, subscription-based information technology arrangements. This is very similar to GASB 87 leases, with exception that those type of agreements were not included under the GASB 87 implementation. So they kind of got their own special GASB to be implemented, and it's a year later. So sometimes I get a question, should we implement them both at the same time since they are similar? I normally say yes, but for this one, because there's so much work to be done with the leases, I'll say no, don't do it.
And the other ones listed under 2022 are also new that will also have to...
Everything that's listed under fiscal year, implementation year 2022, they are all brand new standards. Not all of them will affect the town. For example, it's Statement 89, accounted for interest costs before the end of a construction period, is not going to affect the town because the town does not report any enterprise fund activities, and that applies to the enterprise fund activities. So that's why I did not spend too much time going over this and just focus on the 2 statements that town might be affected, town reporting might be affected. Similar on 2023, town doesn't have any conduit debt obligations now, and if it doesn't have any by 2023, that statement is not applicable. So this concludes our summary of the audit results. So everybody has to come out from this meeting that everything was very good, no findings.
Does anyone have any questions from our board at this point?
I have none.
Okay, so first of all, thank you for coming, and thank you for your explanations. I thought it was very helpful. I know we rushed through this, but this, to the extent folks are interested, we do have extra copies. It is very interesting, and the report itself is very interesting. I have lots of tabs on it points of information, and I'm being totally serious about that. It's very interesting to read, and very readable, which is unusual in financial world. So I'll give Amy credit for a lot of the narrative work to take complex financial terms and turn them into something that is actually fun to read. And I mean that sincerely. So thank you to Amy, and thank you to Maria and everyone who worked on this. Much appreciated, and congratulations. Did we get the award yet? When are you?
By the end of the month.
Well, that's very exciting, and I fully expect you're going to get the award. And when you do, I hope you'll let us know so we can celebrate your accomplishments and the town's accomplishment on this. So thank you. Thank you. You're welcome to stay because it's really riveting what happens next. If you want.
We'll pass.
Okay. So we will now go on to the next part of our discussion, which is to go on to, I didn't even see that on there. Amy, can we pull up the budget modeling thing as well? Thank you.
Guys.
We have a few cleanup items from yesterday. While Amy's doing that, we can ask Maria and Wendy about while we're getting set up there. Let me just turn to my page. And we sort of ended on capital, but a couple of people did have questions on the, and I don't know, Mike's not here, but Linda's probably going to have to recuse from this, but on the Performing Arts Center bathrooms? That was not a vote.
There's
Yeah.
conflict of interest.
On the Performing Arts Center project with the bathrooms, we were curious that there are zero operating costs, zero expenses, zero utilities projected for this, and we wanted to understand why.
Sure. Well, we don't think it's going to get built. It'll be toward the end of fiscal year '23, so it'll be the start of...
Yeah, but the operating costs go out 6 years, and there were none in the out years.
All right, well, I was budgeting for our contribution toward that project.
Oh, no, it wouldn't be in your operating, it would be in the capital project.
Yeah, so I was budgeting for the capital project. Any cleaning expenses or paper expenses we would have in our regular Simsbury or Parks and Recreation Fund operating budget would be fiscal year '24, not '23.
Correct, but our capital improvement sheets that we review do request impact to operating budget for the out years. So we just,
We also haven't come up with it, there's going to be some kind of an MOU on cleaning those bathrooms eventually, for events versus
We're not
public.
using them for events.
Right, so they'll be locked, in that case, then they'll be locked, and then they're our responsibility.
so what can we anticipate sort of a budgetary impact to be on this?
Probably under 10,000 a year paper products, and if we have to if we end up contracting out the cleaning, I think that'd be a start, and then going from there. 3. They'll be used heavily every day. So we'd have to decide, if we're going to have to bring in somebody on weekends to clean them or not.
Maria, how are we handling sort of, I know a lot of organizations, ICMA, GFOA, do recommend that you project out operating costs for all capital projects. How can we sort of quantify it? I know town engineers have systems, and what can we do to sort of maybe get a little bit, if not perfect, a little bit reasonable projections in the out years for something like this? Because what I'm hearing, we're going to be nickeling and diming the budgets for multiple years to come, and what I'm hearing from you is maybe $25,000 to $30,000 impact between.
Over a certain period of time.
No, he said 10.
I gave you 10 per year.
So no utilities, no water?
That's hourly, the utilities.
Yeah.
That's the water and the electricity is not going to be a big push on that. The most of the price is going to be the hourly cost of cleaning, the cleaning supplies, and the paper supplies. That's.
We think it's just $10,000 a year.
That's an estimate. That's an estimate at $15 to $20 an hour for somebody to go in there and clean it.
Okay. So I just wanted to give Maria an opportunity to speak to
Yeah,
your
we could-
thoughts on how we could,
We could prepare a more detailed estimate. I mean, again, it's still somewhat hypothetical at this point. We know that the Performing Arts Center Board of Directors is looking at some donor options. We're waiting to hear on a grant. So again, this project we had initially planned in an out year, but pushed it up in the event that we do receive donations and/or a potential grant. So we wanted to at least have a placeholder in the budget. But again, as Tom said, in terms of operating impact, we were looking a little further down the road, but we can certainly prepare, an estimate.
okay, and same for the multi-trail, like when we extend the trail, there's going to be costs for mowing and, I mean, they're sweeping and little stuff like that. So I don't know what's the best way to get those estimates, but I'm sure Tom could give us their standard projections we could use, I'm sure. But to the extent we can, it would be helpful. Not all projects need that, obviously, because they're one and done or replacement of a current asset. But that's one thing that sort of struck us.
Level set where we are here in paper.
I was talking about the
Tab
capital
27.
project. Tab 27?
Thank you. Go.
Okay. And we had started to talk about capital. Amy, the one thing we did not do yesterday, unless someone has this project specific, or you can wait a second on that, can you pull up the capital financing model and can we review that?
Some numbers in here that are based on these assumptions in the out years, which changes your lines. So right now, I mean, it's pretty close, but right now our 8% line is showing right here. And you can see that this top
It's not accurate.
value over here is well under the 8% because of the increases expected in the budget modeling, because the budget modeling has everything for the out years that are proposed in the capital plans. Whereas the budget modeling, the actual plan, you will see this top layer is going to be pretty much right on that 8%.
Yeah, you showed us that yesterday, so do you not have the access to that again?
No, I do. She just asked me to pull up the budget modeling.
So you want the one we looked at yesterday?
Yeah, the one that's most accurate would be great.
As opposed to, yeah.
Yeah, that's it.
And Amy, the green and the hot pink have already been issued?
No.
Or have already been approved? No.
The hot pink and the light pink here and here have already been approved. The green is fiscal year 22 projects and fiscal year 23 projects. So the 22 have been approved and you all have not approved the 23 yet.
And if we were to bond 500,000 of the current year projects, would this change the graph in any material way or no?
Add bonding for the current year?
No, pay cash for one of,
So decrease the
up to
bonding?
500,000, yeah.
Not that much.
Yeah, tiny.
It does, it gets it at below, in the blue line, before we were above, it gets it a little lower, but,
Yeah, a tiny bit.
so bonding saves about 50,000? Is that because it's divided over 10 years?
I'm not sure of the savings, hold on. Fiscal year 23. And it would be about 1.4. Yeah, I'd say that's probably close.
50 to 55? 45?
Yeah. It's about 65,000.
About 65,000. So over the course of 10 years, that would be savings of 650,000. So long-term savings by bonding 50, although for the current, dealing with the debt spike, it's really only about 65,000 in savings, but there are long-term $650,000 savings. So one of the things we will be discussing, probably not tonight, but on April 6th, is how to use some of that extra 560,000, or if we increase that amount.
That's the 560 from the cash for capital.
From the cash for capital excess. That would be one option. So long-term saving for the town, it doesn't help with the spike that much, but it does help with some of the debt over the long term, and that will be one of the options Amy's going to be evaluating, and Maria, as they give us some recommendations to think about. But as you can see, one of the things I had for you on this model, this is a big increase in the operating budget this year, right? So we normally project 7%, 8% of operating based on the assumption that it's really going to grow about 2 to 3% a year. And if it's growing 6% a year, do we need, our board need to change our guidance? Because we don't want, do we want debt to keep going up to, in some ways, it's the cart before the horse, right? If the operating budget is growing, and debt service is always 8% of the operating budget, but the operating budget is growing faster than we want, then debt service is going to grow. And they don't have to correlate.
You don't have to, yeah.
And so that's one thing I think over the summer we'll be talking about. I think by the nature of debt service, our operating budgets are not going to grow that much by the next few years after this, because debt service is going to swallow a lot of capacity there. But that's one thing we can think about, and so we should think about other markers that our board wants to evaluate as we evaluate how much debt the town takes on and where we go with that. Are there any other questions on debt at this point? Okay. We do have a few things to follow up on from the last, I sent this to you guys, I'm sorry, around 5 because I forgot to do it earlier, things that folks have mentioned either at the meeting or to me after the meeting. One was how to use the 564,574 capacity in the cash for capital. One is to pay off some debt, save 650,000 in the long run, but doesn't really help with the spike. The other will be pension and prepayment, which we don't have the number for, or put it in capital reserve and perhaps assign it for some things. And we did ask you guys to think about it. I don't know if you've had a chance to think about it or cared to think about it until April.
Send us an email.
Submitted it just before the meeting, so hopefully you'll have a chance to take a
got
look
it
at
at
that
5.
before the next meeting. We were able to answer, I think, all but maybe one or two of the questions you asked last night and put that together for you. But we did just send it out before the meeting, and we did address some preferred recommended uses of that money.
So, do you want to just summarize them?
Sure. I think our preferred recommended use would be to put the money in capital reserve, perhaps with two priorities in mind. One might be to utilize those funds to help with the inflation cost increases that will be coming with the Latimer project, which is something I know that we'll be briefing your board on more in the coming weeks. Or second, to use that to essentially use as future debt service payment.
Okay. And I assume, when is your next Board of Selectmen meeting?
The 28th.
The 28th, okay. So I imagine that will be an interesting topic of discussion among your board as well.
564 of the cash to use it differently.
Yes. Like how to use it,
We
essentially.
didn't put it aside to get this cash this year. You had suggested one was to, yeah, I forgot what you just said.
She suggested cash for capital.
Yeah,
Put it
that's
in
what we're
the capital
talking.
reserve.
Yeah, okay. Or use it for bonded items, right?
You could
pay
prepay,
down.
yeah, you could borrow less,
Yeah.
which we're trying to get to. I think everyone's committed to doing that, but we also have some extraordinary needs, one of which is Latimer. We haven't yet heard from Heather and Wendy and your board what level of priority that's going to take among your capital improvement projects. So once you get that, that will help guide us in some of our decision-making. I'm sure that will be an interesting point of discussion. All right, the next one.
So since everybody hasn't had a chance to read the email that we got a half an hour before this meeting, do you happen to have it that you could put it up on so that everybody could read it?
I don't have access to your folder, do you want to, or is it in the budget folder?
Is this the
Do you want me to email it to you?
Yeah, if you could.
This isn't the document, or which email is this? I don't think I got this email.
Do your husband and son know that they're famous?
They do not.
And that they're on television.
Right.
Thank you.
Oh, it is.
Why don't you just, we'll let you walk us through that. We'll take a break, and you can just, we'll get everyone on the same page. You can just do a quick summary.
Just question by question?
Question by question.
Yeah,
sure.
just go ahead.
So you had asked us to take a look, a 5-year look back at the revenues received under our LAP and workers' compensation insurances. We looked at the member equity distribution. You may recall, again, that is not money that's guaranteed to come to us. That's town and Board of Ed combined. Workers' compensation refunds, so that's generally, again, when an employee is out on a work-related injury for an extended period of time. It varies, but generally, our workers' compensation insurance, after the first 3 days, will typically reimburse us in the neighborhood of 60 to 66% of salary for an individual. And again, that obviously varies depending on if we have an injured employee or we don't, and the severity of that injury. Miscellaneous refunds, again, are unexpected items. Usually it's related to property damage, vandalism, things of that nature. And so those are the total insurance refunds over the last 5 years.
And we currently budget
27.5.
27.5. So it looks like there's capacity, just looking at that, we could go to 40, but not a lot.
Yeah, it's a little bit.
It is typical, many towns do a 5-year rolling average in projecting revenues. Is there any reason you can think of why we wouldn't use that as the standard in this case?
I think fiscal year '21 is your classic example where it didn't hit budget.
Where it didn't what?
It didn't hit budget. So for '22, 1,305 in fiscal year '21.
Yeah, so that's why you use the average. We understand that there are going to be some years where you miss it.
But you've got, I mean, I would work off of the total, because you've got these other refunds that come in from time to time as well. So
the workers' comp refunds and the insurance refunds honestly shouldn't even be captured in revenue. We should be offsetting our expenditures with those. This was a prior practice that was done, so that those aren't really real revenues that we generate. The member equity distribution probably is, but the workers' comp refunds and the miscellaneous insurance refunds.
you're saying a check doesn't come in from those?
No, it does, but it should be offsetting the expenditure. It shouldn't be
Right,
its
but-
own revenue source.
One way or the other, you could account for it. I'll answer Elise's question and then say that fiscal year '22, I would throw out as an outlier. You know, I would be more comfortable sticking with something that seems like it's kind of a more common, middle-of-the-road thing. 127 is
It's an aberration.
an aberration. But to assume 46, 47, you know, seems reasonable to me.
So that's a point of discussion. We can have that conversation on April 8th if folks are open to that, about what the number would be. Do you have thoughts on that?
Yeah, they don't like
I mean,
it.
you do, obviously.
You know, again, as Amy said, these funds are volatile. They're not guaranteed. They can fluctuate year to year. And I do agree, Amy and I have had conversations about, again, the practice of how the work comp refunds and the insurance refunds were being posted. Again, that's sort of the tradition and how it was done. It's not necessarily how we would like to see it done, and there are offsetting expenses elsewhere in the budget that those funds are covering.
All right, so that's a point of discussion. I mean, to the extent we change it, we're talking about between 7 and 13,000, which we could probably absorb. And I feel, given that we have 1.6 million in excess revenue this year, it's probably, we could do that. But we'll have.
It's also about future years, though.
Yeah, absolutely. And it's also about sort of the theory, and one of the challenges we have is how do you do long-term projections?
Yeah. I mean,
And
we
one's,
had $1 million extra in revenue this year, and
Yeah. so there's some capacity there. Then on the budget, the vacancy rate, we had asked Maria and
Well,
did.
do you want to just go through in her question?
Oh, yeah, I'm sorry. Go ahead. I got carried away. Oh, well, turns out.
Vacancy was the next one. Anybody else?
So we were asked to do the organizational vacancy rate. We provided those percentages last night, but in terms of what that translates into in terms of dollars of full-time salary, one approach could be to just start a little more on the conservative side and budget a flat amount, which would be essentially $150,000. That would be budgeted as a negative expenditure. If you wanted to do the value of 1.5% of budgeted full-time salaries for the upcoming budget, that value is about $175,000. If you wanted to go more aggressively, upwards of 2%, that would be $233,500. I think anything above that, we start to get nervous. In the 5-year look back, there was 1 year where we were, the difference between budget and actual was only a difference of 1.2%. But again, looking at the averages over 5 years and the median, it was closer to the 2% number.
First of all, I want to commend Maria for doing that analysis. She did show me her Excel spreadsheet, and it's pretty detailed. And it really gives you a sense of what past practice has been. It's been a little different during the pandemic, so Maria did take that into account in doing the analysis. And that's why we're not going to do it by departments, because that's too variable, and some of the departments
Too
aren't
small
small
numbers.
enough. But the town does employ 167 employees, so you could, over the course of it, we can do that without cutting police overtime. We can budget a vacancy for the department that we call the town of Simsbury, and treat it like some of the larger company departments that are out there. My inclination, we can have the final discussion after the public hearing, but I'm leaning towards the 150 or 175, because we can always increase it later and we can see how it goes. And I like the idea that Maria is separating it out from other line items, so we'll be able to monitor that and see whether this was a risk that was advisable or not. At this point, I do feel it's a reasonable risk to take. And
Absolutely. Given the difficulty everyone's having hiring, I would, I'd be comfortable with assuming $200,000.
Yeah, so.
Because that's between 1.5.
200?
That's where I was, just flat 200.
Yeah.
All right, so I won't ask for a vote on this yet, but we do have sort of a leaning towards somewhere between 150 and 200. Anticipate a motion on 200.
Yeah.
Okay.
Next.
So Francine was able to pull together some information for us regarding the question around whether or not we could hire a contractor to perform our audits of the apartment complexes. She said if the question is truly about an audit, I don't know, do you want to go over these ones? How do you just have me on my
It was pretty confusing.
So we can bring it up. Do you want to take this one?
Oh, you know what? I'm going to let that one. I mean, it was just in general. I think we were looking to hire a contractor in general to meet the backlog.
Yeah, well, she did address
Okay.
what, essentially we could do. We are doing, as she mentioned, personal property audits on businesses, and that cost varies between $500 and $600 per audit based on the value that we're looking at. And that we also, for our revaluation that's currently underway, we actually hired 2 vendors. We hired a commercial appraiser as well as one that specializes in residential work.
So we're doing, we do an audit every 5 years during reval anyway. So the only question was there, with the backlog, were we capturing all the lost revenue?
The reval will look at the backlog.
So I found it very confusing yesterday. I don't know if anybody else felt the same. I was hearing on the one hand that there's $3 million out there that we haven't collected. And it was at times portrayed as though we needed help in order to collect that, and other times like, oh no, the reval would take care of all of it, and
It won't take care of all of it.
yeah, I mean, I don't know anything about how property assessment works, but I do know that the notion of leaving $3 million of revenue on the table because we haven't gotten the resources to track it down doesn't sit well. So, I mean, I think what you heard from all of us was, let's figure out how we go get that. And there was a little back and forth on whether we could do the look back. I mean, there was oh yes, we can get some of it 3 years look back, but then at the end she was saying, no, you can't collect it, or that you can collect some of it. Again, I don't know what
Very little,
portion
very
of it you
little.
can, but if you can identify in advance, okay, what are the legal constraints? And, for this 10% of what the backlog is, you can go collect it for 3 years. Let's get somebody on that and get it done. I mean, why let that sit on the table?
Again, I think it's very little that we can go back 3 years, but we could ask Francine what specifically we could go back 3
Yeah.
years on.
So where is the 3 million that we're concerned that we're not capturing, and what is the plan to capture it?
Yep, so we can go to the next set of questions that Francine answered for you. So we're taking a look right now, we didn't have ready for this evening, if we were able to, and actually, if we're able to find folks to come work for us, which again is difficult in this field at the moment, what some of those salaries might look like, so just trying to refresh that. She said what she's seeing for outside vendors who are performing that work right now. Hourly rates are typically in the range of $50 to $100 or $1,000 a day, depending on the type of work that's being performed by the contractor. And you guys had asked what's the backlog, and her estimate, again, the loss in revenue is around $3 million. And also you had asked what would be the time frame. And she said, obviously, the reval company will help us some. We anticipate that'll cover about 2,500 parcels, additional parcels at $30 a parcel.
That's about what is that, about a sixth of the backlog?
Yeah, my recollection, I think from information we had provided previously, was that there was around 14,000.
14,000.
Yeah, so there's plenty of room for additional help there.
Right. Yep, it'll just be finding a vendor who's available or finding a
Yeah.
potential staff member who would be available.
So
Is this-
when it says the $3 million does not include taxes from prior years, so we're saying we're simply undervaluing each year. I mean, we're losing $3 million on the
Every
current
year.
year and going forward, except to the extent that we can recapture it later on. So that's a lot of money.
So what is your recommendation to capture this?
It would definitely have to be staffing or, a vendor. We do have some funds budgeted in the current year that we're sitting in, as you know, and again, the difficulty has been finding somebody to actually perform the work. This is also just a change in philosophy that our current assessor has, which Amy and I agree with, and it's an approach that we're much more comfortable with, is that ideally, once we get caught up, is that we will, in the non-reval years, right, we're going to be capturing those permits in real time. What had been happening in the past is, other than very, very large sort of renovation projects, usually more on a larger scale, say commercial in nature, the inspections just weren't happening. It was only getting caught during reval. Again, it's not a practice we're comfortable with, so we've got that backlog that we need to try to deal with and catch up on.
Is this a business? Are there contractors who do this?
Yeah.
And we have a contractor now doing.
Evaluation.
And do you know anything about what their capacity is? Would they maybe be our first go-to person to check out whether they could jump on this?
So there were limited vendors that responded to our RFP. The two that did respond, Francine was able to negotiate one because they had the expertise in residential, and then the other because they had the expertise in commercial. The thought process is that we have this person assist our contracted vendors for the reval to get this done. So the reval goes out, they do it, but they're not in our systems, they're not inputting it, they're not reviewing it, they're giving us the data. Somebody has to be in that office collecting that data, putting it into the system. So that would be the thought behind having the backlog addressed by the contractors. And then in addition, we would need a staff person to help assist that as well.
Yeah, go for it.
And then going forward, keeping that person in the assessor's eyes, if we don't have that person, you're just going to end up in the same position that you started in. So that's the rationale that she's provided.
Amy, the big drag is you're losing the increased value in taxes in the time between the revals. The reval is the catch-up, but you're losing it, and it's essentially an abatement to people who are doing work but not paying their fair share.
Exactly.
So that's sort of the theory. It's an equity issue about who's paying taxes in this town and when they should pay them. So I do actually support that approach, and thank you guys for implementing that. One of the things, as you saw when we talked about the vacancy rate, well, if you budget a vacancy rate of $200,000, you now can keep taxes flat and pay for the position who could help in the assessor's office. That's sort of one of the things that goes through this board's mind is how can we pay for this without impacting the taxpayers? And that's one way that we think we can do it reasonably. We understand that there are assumptions made in that approach and risks, but we also understand what would happen if we're wrong, and do we have capacity to handle if we're wrong? And we do, with our conservative tax collection assumption rate and past history on revenues. So, all right.
Want to take number 5?
Yeah, I'll take this one. So for the new social worker position for the Board of Education in the town is budgeted in the operating. For the Board of Ed, it would be budgeted in their grant fund. So this is probably accurate up until we made the change at the Board of Selectmen level where we're going to use the revenue loss for the ARPA funding. So for consistency, it really should, the social workers should be moved into the operating budget of the Board of Education, which would be consistent with the town.
Okay, but that would not change the mill rate because there'll be an offset with the grant money. But it will change the number that we're seeing in the summary.
Right.
That makes sense. Okay?
Question 6, I think we covered, which was just in our opinion, what are some recommended uses for that unallocated 564 that's been set aside for capital needs. One option would be, to pay for some projects for 22-23 in cash. As I mentioned, the preferred method, though, Amy and I would recommend would be to allocate the funds to capital reserve, again, given the potential Latimer considerations and future debt service payments.
Maria, would that change if the Board of Selectmen said, you know what, let's use some of the second tranche of ARPA to help out with Latimer? Would your recommendation change under that scenario?
I don't think so.
And can you tell us why?
Yeah, again, just based on the dollar value that we're looking at related to the inflation cost increases, particularly for Latimer. And I didn't know that there are also other, ARPA needs as well, so.
And you would, out of capital reserve, assign the funds to future debt service, so that would.
An option.
And the theory was, but that will create a cliff as debt service is rising until debt service starts to fall and the cliff is relieved. So how do you see that? Doing that sort of like bond premium, a set amount each year?
Yeah, exactly. So if the capital reserve is sufficient, that is one of the uses for the capital reserve, is that we could essentially take a portion of capital reserve and fund a portion of the debt service in a year where we do have like a spike in debt service, again, just to help stabilize the debt service increase in that particular year. So a couple of those years, for example, where it gets closer to 8, right, those might be good years to take a look at assigning a portion of capital reserve towards debt service payments.
And the amount you're thinking ballpark would be $300,000 to $500,000?
Oh gosh, we'd have to take a look at that. We haven't done that level of analysis yet. Yeah.
I don't even think we'd have that information until we go out, because we do our estimates based on, I think, 3%. So we haven't gone out yet. We don't know what the buyback would be. So I think we'd have to go out to bond before we could even make that decision. So a couple unknowns, we don't have our bonding, like I just mentioned, and then we also don't have the true information on Latimer yet. So I think there's too many unknowns. So I feel like that money should be set aside until we have all of the information, and then we can make a decision based on it.
Okay. Going on?
Question 7 was about potentially using the capital reserve to fund a portion of the town's contribution to the Parks and Rec Special Revenue Fund. Yes, that is a policy decision. You could do that. But if you continue to level fund that contribution to the Parks and Rec Fund, it would just be a small cliff for next year. And then question 8, you had asked for a summary table. Of the
Maria,
bond.
before you move on, right now, they were budgeting more revenues than expenditures, so they were budgeting a reserve.
Correct.
So,
A small fund balance, again, weather permitting.
So-
That's largely Gulf generated as well.
yeah, so if we already have taxable reserves, we would just take, why would we tax for reserves that we've already taxed for and just do the transfer?
I don't think I'm following the question.
So he budgeted a balanced budget, actually a better than balanced budget. He budgeted extra revenues to put in reserves. So it's not needed to fund the Culture Parks and Rec budget.
Right, this comes back to the larger issue and the analysis that we did about a year and a half ago, and what we had presented at the work group level is that we have a larger sort of equity issue with that fund, and that the program participants are subsidizing the community use of the facility, including utilities, maintenance of the facility, supplies that are needed. The user fees are almost entirely paying for that, and our analysis had shown that it was probably at least in excess of $300,000 the community use. So really, again, this is to help with that inequity that exists, because right now, essentially, I think, again, the detailed analysis showed is that the golf users are also subsidizing the community use of the facility.
Yeah, I think our board I think Derek actually raised a wonderful point. The community does subsidize both the golf and Simsbury Farms through capital. And in fact, we're going to subsidize $2.5 million this year. So there is some, I don't want the public to think that there's no equity. We absolutely do subsidize this.
Yeah, and I think what I hear from
Larger-scale
constituents is that, and I don't know, I wasn't around here at that time, but that when it was started, it was sort of envisioned for the town that it would be a break-even standalone, that it wouldn't be subsidized by the
There are a
town.
lot of studies that show that aquatics is not a self-sustaining
No, I
fund,
get it, I totally do, but I'm just saying, there are constituents who complain that we're heading in a direction that wasn't what was sold to them at the beginning. Yeah, and times change, I understand that.
Based on, if I'll just add, based on the current model, with minimum wage going up, there's going to be people who can't
I
afford to
know.
go to that pool
Yep.
very soon unless this subsidy starts to negate those price increases.
I think the case was made that the golf course could basically stand alone on its own.
We've been arguing for that for the 3 years.
But you can't, because you're coming to us and asking for how much for a complete redo of the irrigation system. You'd be able to build that yourself if it had been.
If the golf course had been allowed to keep its revenue for 48 out of the 50 years that it's made money, then yes, they would be able to afford the irrigation system. But it's been subsidizing the other parts of the operation.
At a clip of how much per year? 200 to 300,000.
Oh, at least, I think the estimate was.
In the last couple of years at this the last couple of years it's profited.
In excess of 300.
And we've taken the maintenance equipment, we're doing a surcharge for that, so we've taken that out of the CNR fund as well. So the golf course is doing well on its own and standing on its own. Town infrastructure like that, $2.5 million. Again, if the money had been there in a savings account, they could have subsidized, or if it was an enterprise fund, they could have borrowed against it. But that's not the way it's been set up.
So one of the recommendations of about 2/3 of the work group was to pull out golf and put it into its own special revenue fund. But at the time, this board was not comfortable with that. So this is sort of our reality at the moment.
Okay.
And then question number 8 was just to see the bonded amounts summarized into one table for each capital project in 22-23. And Melissa did put that together for you all.
All right. Any other questions for Maria from the backlog? Okay. So going through the list of things we were going to look at, the pollinator project, Tom, you had mentioned it. You view that as sort of a 3-year expense.
Like anything,
Startup
expense, and then it should tail down as
Does it make sense to fund 25,000 out of capital reserves?
Capacity-wise, I don't think we have the ability to handle.
Well, capital reserves, you don't have to spend it in the 1 year.
Yeah, I mean, I guess if the money's there, we just draw off it as we need it, so, then, yeah, that makes some sense to me.
Except, I mean, it's really an operating expense.
As long as we can carry it over, then I guess I don't see the issue with it.
So after 3
You'd have to almost set up a revenue fund for it, correct?
No.
Or its own account?
It would be in the capital projects account, CNR.
Capital reserve contribution through operating, since it's an operating expense that then transfers out to CNR.
Yeah, we could, but you're saying you're going to need it beyond the 3 years.
I'm saying.
He doesn't know.
Right, the 3 years, the larger amount at 3 years, then it should scale back. To a
Or with
smaller-
volunteers, like the beautification committee gets a lot of donations, and it becomes more maintenance at that point. Or it doesn't, and it gets added back into the operating budget, but this is.
Yeah, and the money that we were speaking for with Public Works, that's not necessarily beautification money. They have a separate budget for that. This is more on the town open space and golf course that they don't take care of. In the areas, open space areas that we want to initiate, Iron Horse, the golf
Right.
course, Simsbury Farms.
I mean, it's a small enough number, it doesn't matter.
We charge the bees.
Okay. Talked about that. I had reached out to Matt Curtis. The one issue that Wendy brought up at the budget workshops for the Board of Ed is they are funding 1 sink in Terriffill, but they have a need of 6 sinks, and they still don't have an answer on that, so that may be added or not to the CNR budget come
No, I
in
actually
April.
talked to Jason on that, and he's only comfortable moving forward with the 1 sink right now. He's not confident in the quote or the vendor that they can do what they said they're going to do. So he wants to do a trial run with what he's been provided, and then if it works out, he's okay with proceeding with the rest, but he's not comfortable going full force with all of them.
Okay. The other thing we had brought up, and I think Maria just referenced it, and taking some of the 500,000, putting it aside in capital reserves to use for contingency for capital cost overages. One thing we can do, we've talked about how do we streamline the appropriation process, and one way to do that is to actually budget that amount and budget a contingency amount. And it could be 200 or it could be 500 for cost overruns. And if we budget it, then Maria and Tom Roy, or her designee, then has the authority to spend, and it does not require going back to the Board of Selectmen and the Board of Finance at that point. And if we designate it for increased costs, but not for increased scope, then we don't get scope creep. And the way you monitor that is through reporting, as Art mentioned out at our meetings, we'll get reports as to how that money has been spent. So if people are amenable to that, I'd be interested in hearing sort of what dollar numbers you're comfortable with. I was thinking somewhere between 200 or 300. We didn't have an estimate at the time for Maria. When we had asked her about that last week, I don't know if you have another number that you're...
Yeah, I mean, we had just an initial sort of quick conversation. I think, again, that would be somewhat difficult to ascertain until we actually start, issuing RFPs for projects, and we come back and we see what bids look like. Or in some cases, when we've gone, in the case of like playground equipment, and we're really working with the vendor, the estimates really start coming back. So it's a little hard, again.
So I wouldn't say it's
without an actual RFP and actual responses.
So I would say we're not looking for, the total amount, just seed money, so that as you may need more than what we authorize, in which case you'll have to come back for a supplemental appropriation, so get Board of Selectmen recommendation, Board of Finance. So you can do that too, but it might just...
I think bottom line will cover it either way, but it's a question of making it administratively easier, but if you
Yeah, no,
don't...
in concept, I think we had shared in a previous email in concept. I mean, I think it's a helpful, concept and a helpful idea. I just don't feel like we're in a position to say, X amount's going to cover it and we're going to be all set.
Oh, no, I wouldn't say it's going to cover it. I look at this, start with 250. If you don't need it, great, it's in capital reserve. We can use it for debt service reliefs, or if you do need it, and if your board is comfortable giving that authority to Maria, so I would want some impact, some input from your board, Wendy, if you're comfortable with that, because it is a little bit of a broad authority.
So you're taking a chunk of reserves to say that, just like the thing we just did for the PAC,
To sort of earmark it
came to
for,
us, we wouldn't have had to do that, but
Like what you do when you let Eno, or you do the permitting.
it just saves a lot of the paperwork, is what you're
Right.
saying, and the 3 levels of approval.
Right. And we don't know the right number, but we could start at a reasonable number.
There should be contingency layered into any number we see to begin with. So I don't know if I'm fully supportive
Okay.
of that.
What-
And it could be temporary, you know.
right, construction costs could come back down a bit.
Well, yeah, prices go up faster than wages do, but I think with interest rates going up and the Fed being hawkish and 7 potential more rate hikes, that it's going to affect the economy. So I just don't, I think that prices may start slow, or at least demand for commodities might start slowing a little bit. But that's separate from any type of contract that you get, that contractor layering in, some level of contingency. Contingency has been going up over the last, call it, 2 years, I'll say. And it might start coming down. So I don't know if I'd want to set something up where we're just, plugging a hole this year and then we have something going forward that we don't need.
I have just a question, if you do that, how does, just like the last thing that we just did, it made the public aware that there was an overage, or just say the Simsbury Farms Playground came to us over $75,000, and let's say it was during the budget, we would have done the supplemental appropriation for the $75,000, so the public would have, even though it's kind of layered, they would have known that we went over and we were spending the money. So that's the other flip side of putting aside the money and letting us use it for these other.
No, I agree with that. I'm actually responding to Mr. Peterson's very harsh words about multiple approvals needed for contingencies. So it's another option. I happen to think democracy works very well in Simsbury, so it's not a problem for us. It's an administrative approval. Your board had expressed some.
Yeah, right. It's a really good thought. I think it would be up to really Maria, and if they felt that was valuable to not have to go through this process every time. I don't mind it, putting the agenda item. They're fairly easy for us to do it and acknowledge what the change is, but.
And not very controversial, and it does give the public notice.
Yeah.
The other option you could do is Maria could be required to do a formal report, and would be the same thing. So I don't care, but that was brought up at your board meeting, and so I did want to put that forward for you to consider, and why I asked, we would ask your board's input on that, whether that's something you want, but what I'm hearing actually right now is that nobody really wants it, so. But if that changes, let us know. Okay, Amy, could you please pull up the excellent summary document you gave us, and we'll sort of see where we are?
Pension motion, or that's later.
Yeah, we'll do that next. Thanks. Thank you, though. So this, Amy did a great job pulling this all together, is sort of what it looks like. And you can see it's a pretty big expenditure increase from last year to the current year. Amy, when we do debt service as a percent of operating budget, we're not incorporating that full expenditure increase in our debt service graph, right?
Right.
Because just the increase that's not included in the ARPA grant, is that right, in the debt service graph?
Yeah, ARPA's not included in that.
We're looking at an
Okay.
8.5% increase in the total budget.
So is that an 8.5% increase of the total town budget? What would the increase on the Board of Selectmen be without the ARPA? Is that about 7%? I came up with about 7.
Seven something, like that. Yeah, so it'd be about 705, give or take.
That's pretty big.
7% increase in expenditure. A lot of those, I think the Board of Selectmen added 500,000. Is that about right? So Maria, you came in at 3.4, and now we're at 7?
4.15.
Oh, 4.15.
I guess that shows how much we added back.
Where did the letter go?
We can give you an exact dollar number of how much the board
4.15.
added back as they work towards a flat mill rate.
Okay.
Yeah, so again, a policy recommendation from the Board of Selectmen, again, was working towards that flat mill rate for some stabilization there. And you can see on the right, it was a combination of some operating adds. I had flagged a number of potential service improvements for consideration, which they typically will look at those various priorities and pick some number of potential service enhancements. And then also, as you kind of work your way down that list, you can also see the 564,000, which was that sort of additional capital capacity to get to the flat mill rate. But hopefully those dollar figures and items help you visualize what they added back.
So about 500, a little over 500,000 added back to the operating budget to get us to 7% expenditure budget increase, excluding ARPA. That's a big number, guys. All right, can we go back to the other sheet and sort of look at that? Then debt service and capital, what's driving that? We would have had a negative debt service. That would have been minus about 177,000. But we are pre-funding needs of the town in that capacity to get us to a flat mill rate, which will help us with some of the spikes in the future year. So that's why that's going up 13.8%. So that's a plan, not a required increase, but it's a policy decision to help smooth the mill rate. Then the Board of Education came in 347. We had a conversation on that. Non-public schools 411, which is a state mandate, so we don't control that at all. So with the revenue, I think what really tells the story is the less estimate non-current year tax revenues. You see that jumps from 10 to 16 million. Most of that's driven by ARPA. Some of it's driven by the grantless growth. Some of it's driven by ECS, educational cost sharing. We have about 600,000 more than we budgeted in the previous year, 400,000 more than we got. So you can,
Why does ARPA fall under the category of non-current year tax revenues?
where do you see that?
I thought you said that's what accounted for the $6 million.
No, for the 16 million, can you put the marker on that? That's what's driving that increased revenue, is the American Rescue Plan Act revenue.
Right. I mean, I'm new to this, and I don't understand why that's a tax revenue.
Because it's money we're getting that we don't have to tax. It's a gift that we have.
Okay, so I see. So the non applies to the whole phrase.
Just the whole
It's
phrase,
not
that's
a
right.
current year
You could take
tax
out the word
revenue.
tax. It's not a Simsbury tax.
Yeah. But actually, thanks for clarifying that.
It is tax revenue, but it's not Simsbury.
Not Simsbury tax, not right. Less estimated current year property tax revenues. Okay. Yes, it's taxed at the national level, you're right. But that's sort of why we're coming in, and then it says balance to be raised, and 98,188,274, and it looks like a 2.39% increase. So that's an increase in taxes, but we have the reason why the tax rate for individuals is flat, because the grantless grow. So that's sort of the theory behind that. All right, now, can we please go to the expenditure sheet?
That's very helpful, that big picture.
It's very helpful. Can you go, I'm sorry, the budget modeling worksheet again? And if you go to expenditures and take out cash for capital and additional cash and CNR, so about 1.3 million. Oh, wait, before you do that, show everyone what the next year's taxes are going to be. Let's,
About $9,800 on a $350,000 house.
Sorry, can you just point out where, oh, there's the 350, okay, yeah.
so you'll see that's an increase of
Of
about
$600.
$672.
Pretty hefty increase.
Amy, when you did your initial analysis, it looked like it was going to be much higher than that. What changed? It's a reval year. Did you make any assumption changes, or did some information change?
Yeah, so the initial one didn't include the flat mill rate for this year. It included the initial town manager's proposed budget, so the variance was much greater.
I'm not understanding.
So when we had the town manager's budget, we had a decrease. So the fiscal year 24
Oh, got it,
increase was
got it.
greater. Yep.
Got it. Okay.
7% is a pretty hefty increase in 1 year, though. I'm kind of uncomfortable about that.
Well, let's make it better.
Yeah.
So let's take out cash for capital in that year.
In fiscal year 24.
Mm-hmm.
We don't have cash for capital in fiscal year 24.
You have CNR cash for about $1 million, though, right?
Oh, so you're not talking about this million?
Yeah.
This million?
Yep.
Okay.
And do we have, did that million include the additional cash and CNR that we have this year budgeted? So that's the total amount we could take out?
Yep.
Okay, let's go back and see what that is. It's a
Knocks
six.
it down to 6 and a
And
quarter.
what is that assuming for an operating budget increase for the Board of Selectmen and the Board of Education?
About 3.4%.
Okay. And it's assuming 1.45 for grandless growth?
Well, it's reval, so I mean, it's showing 14% increase, but
So the reval is assuming a major increase in, yeah.
yeah. I mean,
I'd
it won't
probably
impact
disagree
all
with that.
homes, but it'll impact a lot of homes.
So we've been off on our reval anywhere from 3% to 0.5% is probably the best we've done. What if we increase that by 0.5%? We do better than that. What if we come in better than that? What happens to the mill rate by 0.5%?
I'll just get a guideline. 2. Close enough.
Then we get it down to 5.9. Now, if we go in and the Board of Selectmen and the Board of Education come in with budgets at 2.5%, what happens?
So you're trying to show what changes we may have to make next year.
It's sort of the ghost of Christmas
Yeah.
present, the ghost of Christmas future. What could happen?
It's off there.
Are we factoring in potential use of that $3.5 million ARPA money next year? for the
No.
top? So we will have that as a tool to reduce the taxes because we can pay for a lot of the capital items if we want to in next year's budget.
Well, we've taken out all cash.
The one that you just took out, the 1 million.
Yeah.
Oh.
So we can get it down to 563. So that's a tough year. That's 800, yeah, that's 800. You can see what's going to happen. So I think one of the things we're going to be doing is hope we get a good grand list growth. We can see that there's going to be, one of the things we talked about when we bonded Latimer and Meadowood was we can do that, we can go up to 8%, but what happens when you increase debt service, that's like its own department, and it starts putting pressure on every other department. As that department is growing, every other department is going to feel the pain and be pressed down. So just to keep folks in mind on that. Is there anything else, Maria, we can do this year to get that down? One is we can reduce the debt service payment next year by using some assigned money. So let's use some assigned money. Let's use $500,000 next year to pay down debt service. Amy, what happens if we do that? It gets us down to 5.5% increase. It's still 469. 469 divided by 12 is, how much is that a month? I can't do that in my head, sorry.
40.
39.
So it's going to be,
Close, huh?
so it will be the largest tax increase we've had in probably a decade and a half, maybe 2 decades. So we'll be monitoring that. It'll be interesting to hear what the public has to say about the budget we're proposing this year. But it's just a good preview. What could save us? Grand list growth if it comes in better than we expect. Other things that can help is, obviously, use of capital for future years can help in the future years as we try and get that down. But as you can see, we don't have a lot of tools that we're going to be able to use to address this spike next year. We will utilize as many of them as we can, but we're all going to need to sort of come together next year. I think it'll be tough.
What's our fund balance as a percentage if, assuming this is correct?
The general fund?
Yeah, the general fund balance, yeah.
We come in higher this year. We went to capital reserves. I would probably say around like 16, 17 ballpark, rough ballpark.
Yeah.
And then I had a question about an additional expense that maybe you've built in, but, and I know I asked you and I forgot your answer. When we talked with the pension actuary, she suggested we make an extra payment. That's not in the budget, right?
No.
So if we actually take her advice, then we have yet another expense to add this year. And was that a one-year thing, or was she suggesting we do that next year as well?
We don't have her recommendation yet. Amy, do you have any inclination where she's going with that?
So when she came to present, she recommended that we never decrease the payment. So this year would be a decrease because last year we had such a large contribution due to the mortality tables. So she's recommending you should never decrease the payment, always keep it flat. But the other thing that she's looking into for us, which she mentioned, is changing the amortization so that it's not changing the years, but it's changing when the highs are. So right now we go like this, right?
Yeah.
If it's good, great. If it's bad, we have to deal with it. The amortization, the way she's changing it, all of our high payments will be in the beginning, and it'll amortize down, kind of like what Nicoletta was describing earlier, and go lower and lower. So we're never going to have this anymore. We're going to have this.
But do we go from here or there as we start that new amortization period? We don't know. So I think clearly we're not going to be able to start that next year if that's the recommendation. We may have to delay that. But there are a couple sort of elephants in the room. One is the pension payment. Two, the experience study may reveal that we are underfunding, but last time we did an experience study, it turned out we were overfunding, and we actually saw a pension relief. That was in 2012. Yeah.
The
The
audit.
comment she made was that most likely it'll increase expenses.
Right. Question is, why are we doing that? Because we made the promise and we're going to keep that promise. And it's a best practice GFOA recommendation.
Yeah, I'm not questioning.
Yeah. No, I know, for the public. This was unanimous on that. So a couple of things that are out there. We do have sufficient reserves to deal with a lot of this, but it'll be, but Amy, are you including in this the 29 mil car payment?
Yes, I think. Yeah, so that's the value at current mill, and then that's the value at the 29 mills.
So here's what saves us. If this legislation passes, That's, what is that? The difference between that and that
Oh,
is
so
is 90.
taxpayers won't see that big an increase next year because they'd.
There would be an
But
offset
would
in our
that be
payment.
going to affect?
We don't know.
Yeah, probably in this coming year, so,
Would that be for this year's or for next year's taxes?
well, for
2024, when
2023.
does that hit?
Yeah, so it was
2023.
proposed for the 29 mills to go into effect for the upcoming fiscal
Right,
year, but then some of the
2023.
other nuanced changes in the legislation around depreciation, et cetera, would be the following year for implementation.
So there may then be some property tax relief in motor vehicles that could offset the increase in the,
a little bit.
a little bit. All right. So at this point, we do need to take a motion on the pension investment assumption. We have spoke this, as Derek wanted to point out, and as our chair of the subcommittee, do you want to talk about the subcommittee's recommendation, and then we'll go ahead and take the vote, confirm
Yeah,
that we
we
have that.
actually had, we heard from the consultant after we made their recommendation, but the recommendation from the pension subcommittee was to reduce from 6.25 to 6.5%.
And that was a unanimous recommendation of the
That was.
pension. Okay. With that, and of course, do I have that motion with me? And Amy, this is to reduce both the pension and OPEB investment. Okay. May I have a motion to move effective March 23rd, 2022, to approve a pension and OPEB investment interest rate assumption of 6.5%?
So moved.
Second.
Any further discussion? All in favor, please say aye.
Just discussion. I think maybe it should be noted in the notes or the summary that there was a recommendation from this pension subcommittee.
Friendly amendment
Yeah,
to the motion, move effective March 23rd, 2022, to approve a pension and OPEB investment interest rate assumption of 6.5% upon the recommendation of the town's actuary.
As recommended, but
As recommended
As recommended by the
By the pension
subcommittee.
subcommittee.
by the pension
Because
subcommittee.
it wasn't necessarily a recommendation from the consultant.
Ah, okay.
Could the motion just also reference that it would start either July 1 of '22 or essentially for fiscal year '22, '23?
Sure.
Yeah, that'd be great, thanks.
As amended?
So-
Okay. Does
Second.
anyone need that repeated, or we have that captured?
I'm good.
Okay. All in favor, please say aye.
Aye.
Okay, that's good. The next thing we need to do, we can see that there may be some adjustments made after the public hearing. I think in a case when you are having a 7% increase or a 22% increase in expenditures, it is good to get public input before we make any decisions. I think Wendy and Heather have some things to bring back to their board to discuss, and we'd like their input on certainly a few of these issues. And looking forward to what the public has to do. So my recommendation is that we forward the budgets to hearing, not as recommended or approved, but for comment before we make our decisions at that point. And now Wendy has me all confused. Is the hearing on the 5th or the 6th? Okay. All right. On April 5th. And that will be at the library, I believe, this year, right? So we'll do that at the library program room. And then after that, we'll have the opportunity of making adjustments or forwarding it to public hearing or continuing the hearing. And if we continue the hearing, that will go to April 19th. One of the things I had talked to Wendy about is I know she's very cognizant of the fact that there's a lot of money to be spent in the second tranche of ARPA, and there is still some capacity in the first tranche of ARPA to be spent. Some of that money may want to be spent in the current fiscal year, which will require a supplemental appropriation. So to the extent Wendy and Maria and Heather and everyone, if you know what that number is by April 6th or April 19th, we could do it at the meeting when there are a lot of people there and take care of that, if that time frame works for you guys.
And we could use the money before July.
You could use it after the meeting, once it's, yeah. So it would be available to you as a supplemental appropriation in the current year, but it would be done at a publicly noticed meeting So
So if our finance, we have to get our finance subcommittee meeting.
if you can't, that's fine too.
No, we need to, because we were talked about making some adjustments for the outside agency 501c3s, if they want to come to us.
Yeah, and I do really want to commend your board and Maria and Amy and Melissa for working to get so much of this budgeted, because this is really a very transparent way to appropriate the ARPA dollars and gives the public an opportunity to cast their vote. And later, if they complain, they say, who approved this?
Well, it makes our life, all over the place, a lot easier to do it as part of the budget, which would be nice if we can hold off and do a lot of it next year.
Well, but I do appreciate all the work you guys have done. I know, my gosh, what a heavy lift that was. So thank you for your efforts on that. And thank you, Tom, for being here, and Chief, and Jenna, and
Everybody.
Lisa, I mean, Kristen, who's hidden, what? I know. I'm sorry, I'm not going to go through everyone's name, but thank you all for being here. I do want to ask if there are any other comments before we go ahead and forward this?
Yeah, can you just bring me back from the 22 to the 7? I'm sorry, I
Yes.
nodded off for a second, or I just...
No, go ahead. Can you pull that back up again?
What are we looking for?
The sheet. Yeah.
What took it from the 22 to the 7? What's that gap?
So when they're showing the expenditure increase, so they're spending a lot more than last year, 22% more than last year, but not all of it's being funded by the property tax. Some $3.5 million is being funded by ARPA.
Oh, it's ARPA.
So the property tax increase is 7%. The total expenditure is 22%.
So I guess the only thing that I'd be curious about is of that additional 15%, or the ARPA dollars, what is attributed to ongoing operating expenditures?
So I think just the social workers, right, Maria?
Right.
Is it just the social work?
Yes, that was
Okay.
the only operating proposal that would be ongoing.
And Board of is funded 2 years for $450, so
New police and, isn't
that's not funded by ARPA, that's funded by the operating.
No, he was asking what's the ongoing, did I misunderstand?
No.
What are the ongoing operating
Yeah.
increases?
But
Through
that-
the grant.
Oh,
Yeah,
that the grant is
exactly. Yeah, that the
covering.
grant.
I'm sorry, I didn't hear the whole question.
And if it's just, I totally understand. Okay, good.
Over 2 years.
I can do the quick math.
Yeah,
Bordentown.
I think that's right, Wendy.
Yeah.
It is.
yes.
Maria-
Yeah, it's like.
So I didn't-
But my head, yes.
to do that.
We have our benchmarking towns. Can we get expenditure increase, sort of comparisons from our benchmarkers? I know we had the mill rate increases, but the actual expenditures, what people are spending.
Yeah, and I know a lot of our counterparts are in very similar situations. You know, folks, I think, where they can, particularly with capital, are trying to put things into the budget, and also, taking in ARPA dollars. But do you want me to pull up that comparison sheet that
So
we
it
showed?
has the mill rate, but it doesn't show I'm just wondering, are people spending, increasing their spending by 22% and 7%, or are they, I was just wondering how our spending is in line, as opposed to, our taxes are in line, we're coming in flat, we're doing as well as or better than some towns for this year.
I'm just taking a peek at that. We can pull that up in just one moment. Did we send that Monday?
That was just the mill rate one.
Yeah, I think we sent that on Monday. Sorry, give us just one moment.
Yes.
Okay, want me just to email that to you?
Sure.
You mean what Matt gave us, remember, when he gave us the summary of the budgetary increases?
Yeah.
So those are sort of the mill rate, but you can't tell what they're expending. So could we just, when you get a chance, if you could have that just for the public hearing, that's fine.
And we'll probably have the rest of the information from the town. So particularly some of the towns that don't have a Board of Finance, the town manager budget is usually due considerably later in the process, so, and or just the timing in their charter. So when we did this last week, there were a few towns that the town manager still hadn't released their budget at that point. But by the end of this week, I believe 2 of the 3 on there will also be released. And I think Windsor's the latest. We might not have their information, I think, until the first week of April. Yeah. And it's also just at varying stages too. So for some of the communities, it's still at the town manager proposed budget. Others,
Sure.
it's, at the town council, board of selectmen. So we did our best to just to try to, show you where the folks are at various points in their budget process right now.
Yeah, so if we can just do, sort of see expenditures, just to get an idea. I'm sure a lot of people are spending more than they have in the past because they have the American Rescue Plan Act. But I think it would be helpful, because if they see a 22% expenditure increase, to see that other towns are doing similar would be a helpful comparison.
Oh, and maybe just one piece too for this chart. I'm not sure if folks had a chance to take a look at it, but West Hartford was the only community in the group that their reval essentially was affecting current year budget. So they did have a pretty substantial mill rate decrease as a result of the reval.
People are spending more just because of inflation as well, 7% year over year. So that 7% actually resonates pretty well with me from a increase perspective. But I think that, just generally speaking, in terms of a reval next year, I think we should think about values as it pertains to higher borrowing costs. I think naturally values will come down.
Yeah, I agree. But it certainly argues for, the big increase next year argues for that assessment project. Get that extra $3 million, that would really solve our problems. Agreed.
Can I just mention one other thing that hasn't come up, and we don't really know anything about it yet, but the IIJA, the Infrastructure Investment and Jobs Act, which we're going to hear more about next week, that's a potential source of funding for infrastructure projects, roads, bridges, trails. Drainage, yeah. So that, I think more will be known between now and the end of the year. So that could be another tranche of cash. We could be hopeful that could come and help us on some of our capital projects.
That's the kind of thing where we don't generally like to substitute, but you could do Town Aid Road with that tranche during the debt service spikes, and as the debt service spikes, but add it back in as an offset. Yeah. One thing I forgot, and I'm sorry, on the Performing Arts Center, that's a matching grant. Have we set aside enough in the budget to meet the match if we get the grant?
Not for the state grant. We would probably need more. But again, we just don't know if it's going to be awarded, if so, for how much. So what we did is we carried forward the placeholder of the project. So initially, we had a standalone restroom project for sort of everyday use, and we're doing a placeholder in the range of like $330 to $350 for that. So until we just have better information, and also not sure how the fundraising efforts will go, we wanted to at least keep the value of that standalone project in there as a placeholder, but we potentially could need more, depending, again, where the fundraising comes in, where the grant comes in.
And sources for getting that could be the American Rescue Plan second tranche or capital reserves, right? Okay. All right, well, with that, Amy, if you could help us sort of formulate a motion, my inclination is to, if you could pull this up, to forward the budget as, are there any, just the top, because you might, I don't think there are any major changes, right?
No.
We didn't make any.
I think,
Are there any of the things that we discussed that the Board of Selectmen would want to see done
In advance?
in advance? You could.
I think that's consistent with the budget that you all had submitted. Right now, essentially,
to look at this, you're just
they're
saying?
sending it to public hearing,
Yeah.
and it's reflecting the budget that you had submitted to the Board of Finance.
So this is not an approved budget,
Right.
it is just a budget for public comment.
Okay.
I think Melissa did the motion.
Oh, yes, Melissa did send the sample motion, yeah.
So in this case, there's no amendments, so it would just be the motion to refer Board of Education, Board of Selectmen capital budgets as proposed by the Board of Finance to public hearing.
Well, I'm happy to move that.
Okay.
I'll second it.
Any further discussion?
Nope.
All in favor, please say aye.
Aye.
Motion carries. And we do have the Finance Director's report. I didn't even see that on there. Amy, obviously, the big update is what's going on with Board of Ed, and is there progress being made, or is it getting worse?
No, so the initial 5 to 7, I think I had mentioned last night, isn't going to come to fruition. I think they're at like 3.2 right now.
Oh, great.
They're in talks with the state, because the state will not let you go out to bid unless you have support for the full
Can
project
you,
cost.
maybe this was did I miss this conversation? Bert's looking perplexed too. What are you talking about?
So I asked, I was talking about the expenditure deficit, not the Latimer.
Oh, no.
Oh, okay.
I'm glad I asked. Everybody was on a different page.
Oh, I thought, so what are we
Expenditure
talking about?
overage that they're anticipating.
So for the current fiscal year?
Yes.
So no, we haven't run updated projections since the
It is
last
lower than
couple of
that.
weeks.
No, it's not.
Okay, that's, if we
Could you
could.
clarify what the question is?
Yeah.
Yeah,
What are
so
we
what,
talking about?
the Board of Ed, last night we referenced, it was discussed, that the Board of Ed is facing they had an unexpected increase in costs, I think mostly, what's causing them?
Special education.
Special education costs, which is a variable cost need. And that has caused them to project that they may not hit their budget. They may come in over budget. They will not come in over budget without a supplemental appropriation, because there's no expenditure without an appropriation, but they will probably come into us for that appropriation at some point. They're working really hard to do everything they can, freezing, buying supplies. They're taking all extraordinary efforts to get that as low as possible. How much do we have in the non-lapsing fund?
685,000.
So that would cover it.
So we do have that there. It was actually,
Wasn't it
the
3 million?
non-lapsing fund was started precisely to deal with this variable expenditure problem that all education departments have across the
And
state.
for Bert's sake, when they have a surplus at the end of the year, we allow them to carry it forward in this non-lapsing fund for unexpected
Sure.
things that come up the next year. So
But didn't I hear that we're anticipating $3 million?
Oh, so there's this, all right, let's move on to the second thing. Latimer Lane, we had talked
Oh,
about.
so the $3 million is Latimer Lane?
Yes, Latimer
Okay.
Lane. Yes, there's no additional 3 million. We're still at 3 million.
Before we go on to that, though, wasn't the non-lapsing applied to this year's budget?
How much, that's a great question. I actually had that and I forgot to ask that.
Yeah, so it was applied as a feathering in they added 6 new positions. That would be grant funded for fiscal year '23. So we did utilize the non-lapsing as a feathering in to cover the cliff over the next 3 years.
How many for the current year? Let me
I
see.
believe it was about 300,000.
Where does that show in this line item? Where would we see that of non-lapsing?
In fiscal year '23, you wouldn't. It starts in fiscal year '24.
Oh, that's what I meant.
So
Okay.
you're saying that money's already been sort of
Earmarked.
earmarked and isn't available to cover the shortfall?
Well, it is.
Well, it
Unless
is.
we just change their current budget.
Exactly.
Or they change their current budget.
I mean, they could do something else in their expenditure budget to change too. Yeah.
Is the non-lapsing is what they're going to use also for the social workers too, correct?
They're going to use it in 12
Yeah, that's what,
different places.
I think that's what Derek was referencing, yeah.
okay.
Yeah, so, but that's not for, there's no planned use of education cost-sharing dollars in fiscal year '23 budget.
Right.
We may use some of it in fiscal year '22 to offset some of this increase. But we also have the tax collection assumption rate, which comes in between 500 and 600, which we also have for precisely this reason. Now, we would like to use it for capital reserve and to offset some future spikes, but we may not be able to do that.
If there's enough in the non-lapsing within the Board of Ed budget, and it's a Board of Ed shortfall, then that money should be used.
Yeah, I agree.
That's the first look, yep. I mean, money is fungible, so at the end of the day, we'll meet the will meet the needs of the town, but we have certain buckets. But that was precisely the reason the fund was established in the first place. So that is a possibility, an expected expense. So we'll be monitoring that. When do you think we'll have a better update on that, Amy?
The closeout, March, probably around the 10th to the 15th of April, so probably for your end of month, April.
Okay. And
Your
I
April 20th meeting likely.
Okay, 19th. And Amy, can you guys just give us broad highlights on your report? We'll
Yeah, it's super quick.
What did she say?
What did she say?
well, there's actually a report in here at the end,
So
Amy's.
there's just a couple of the updated grants and donations, and then the financial summary as of the end of February, just in comparing where we are at this point this year compared to the same point last year. Under your total revenues for fiscal year '21 received, we're at about 96%, and current year, we're at about 95%. So pretty consistent. And then under expenditures, kind of the same thing. Prior year, about 65%, and current year, about 61%. A couple things under the expenditures, you'll see that under the intergovernmental transfers, there was an additional $2 million that was transferred into the capital reserve fund, which is the major variance there.
What, can you just explain that one?
Yeah, so that was done as part of year-end transfers for the year before. We had done the transfers later in the year, and so they impacted the current year. So when you all wanted to get down to your fund balance goal of, I believe it was the 15.5, we did a transfer out of the operating into the capital reserve fund.
It's just showing up now.
Well, it shows up in fiscal year '21.
Oh,
It's 21 compared to 22.
got it. And in terms of year-end projections, we're still on target for the year-end estimates that you provided in the levy
I
sheets?
haven't done any updated estimates. I'll be doing them for the end of March, so I'll know better then. I haven't run any new reports.
But there's nothing that's standing out here.
Nothing that I've heard of, no.
Okay, so that's still a healthy savings, about 500 to 600 in operating savings and about 1.6 million in excess revenue. That will be an additional tool that we'll be able to utilize in the future years. All right, is there, seeing nothing else, may I have a motion to adjourn?
Oh, come on, let's stay another hour or two.
I do have a question about
Yeah, go ahead.
Latimer.
Go ahead, Derek.
I thought originally it was like 6 to 7. Now it's magically 3. I just trying to figure out what caused it to go down.
So I honestly don't know. I haven't been part of the PBC discussions. I think the owner's rep kind of threw it out there at 5 to 7. Staff wasn't aware of it, and they weren't aware that they were going to come out with that number. So obviously they were a little perturbed, and they went back and they had conversations as to what made up the number. And I think there were some scope increases in there that were not authorized. They were probably just part of discussion. And then they got it down to the actual inflation of about 3.2 million, I think.
But the scope that was approved is not changed at all? No value engineering or anything like that? Okay. Thanks.
All right. So do we have a motion?
I move to adjourn.
I'll second that.
Any further discussion? All in favor, please say aye.
Aye.
Thank you, everyone.